come to 6 monthly policy review for this year, and we have 2 more to go, one in October and another one in November. So as you are already aware, Monetary Board decided to maintain the current monetary policy stance while taking into account the downward adjustment of the market interest rates in response to monetary policy measures which have been already implemented during the year, and also the need to allow for further space for rates to adjust downward swiftly. Therefore, the policy interest rates and the SRR remain unchanged. The standing deposit facility rate stands at 11%, standing lending facility rate stands at 12%, and the statutory reserve ratio stands at 2%, which was revised downward from 16th of this month. However, the Monetary Board took note of the excessive lending rates of certain products in the market still, which is sort of not in line with the current monetary policy stance. Therefore, the Monetary Board decided to adopt targeted measures to reduce excessive lending rates, and also Monetary Board decided to direct the licensed banks to reduce overall rupee lending rates going forward. I'll show you some of the existing interest rates of selected products which will be subject to some maximum interest rates. The first chart shows the pawning interest rates across banks. These rates range from 17.75% to 26%, but Monetary Board proposed a maximum rate of 18%. And the other chart on the right, the pre-arranged TODs, again these rates range from 20% to 36%, and the proposed rate is 23%. The chart on the left below is that the credit card advances interest rates, again ranging from 29% to 34%. The cap is 28%. And the penal interest rates, which are the rates charged on delayed payments, ranging from 2 to 4%. So that will be capped at 2%. And the directions will be issued with regard to these measures, and these measures will be subject to further review in accordance with the overall monetary policy stance of the central bank going forward. Another measure that would come into force is that some direction on the reduction of the overall rupee lending interest rates, because as we are showing here, a comparison between lending interest rates and the deposit interest rates compared to the policy rate level. So the blue line is the deposit rates, new deposit rates, which have adjusted quite notably, well in line with the current monetary policy stance, but the lending rates are showing a slower adjustment at 19.3% now compared to 12.45% of deposit. So there's a wide spread between the deposit rates and the lending rates. So there has to be some faster adjustment of the lending rates going forward. So to share some information, the developments on the economy, to begin with inflation, as again you have seen already, inflation in July came down to 6.3%. That is headline inflation of the CCPI basket. And the core inflation, which reflects the underlying demand conditions of the economy, has also come down to 6.1%. As we are seeing on the other chart on the top, the headline inflation now is touching the target range of inflation, which is 4 to 6%. So we expect that this month's inflation will come within the target level. And the chart below, bottom chart on the left, shows the comparison of inflation between the peak that was in September last year versus July, the overall inflation was 69.8%, now at 6.3%. Core inflation 50.2%, now at 6.1%. Food inflation was 95%. Now July it was a negative inflation of 1.4%. Non-food inflation came down from 57.6% to 10.5%. And the chart on the right below, bottom chart on the right shows the factors, basically the base effect and the momentum, how these factors helped to bring down inflation. You can see the base effect helped bring down the high inflation rates thus far during the year. And because of the tight monetary conditions, we didn't see much of momentum in inflation on month-on-month basis. So without month-on-month basis inflation due to tight monetary policy measures, the base effect helped us to bring the very high inflation rates to this level. And going forward, you can see August and September also we will benefit from the base effect to some extent compared to the large adjustment that we saw. That this will help us to stabilize inflation around the mid-single digit level going forward. So we have the fan chart showing the projections that we did in July. So and the red dot shows the July monthly inflation, whereas the fan chart shows the quarterly averages. So we will see inflation stabilizing around the mid-single digit level going forward over the medium term. But there could be risks to these baseline projections, both on the upside and on the downside. Upside risks mainly include the possible impact coming from the drought conditions, which are impacting the economy overall, and also some possible weather-related developments toward the end of the year as well. And also globally we are seeing the energy prices are rising and food prices are also rising, so there will be some impact coming from that as well. But there could be downside risks to inflation projections as well, coming mainly from the normalization of supply conditions amidst improved forex liquidity, and also the relaxation of some of the import restrictions. On activity, we are seeing a faster recovery in the services sector. The PMI services is showing an expansion now for continuous 3 months. From May to July, we see the index is remaining above the 50 threshold level. And the PMI manufacturing is still below 50 threshold level, which shows a contraction. And so the leading indicators point towards a smaller contraction in Q2 this year. We will see the numbers mid next month. And but over the medium term, we expect the growth to gradually reach towards the medium-term target levels, supported by the normalization of monetary conditions and the improvements in business confidence, enhancements in supply conditions, and the growth-promoting reforms being implemented by the government. However, the impact of weather-related disruptions and the modest external demand conditions could weigh on activity in the near term. On the external front, we are seeing resilience despite pressures, but this resilience has allowed gradual relaxation of balance of payment restrictions and other measures that were put in place last year. Exports are exports have moderated to some extent compared to last year's post levels, but still hovering above 1 billion level. And the imports are yet to show a recovery despite the relaxation of some import restrictions. The government has already relaxed 638 HS codes, including some of commercial vehicles as well. But despite this relaxation, we are yet to see a recovery or pickup in import demand, mainly because of the tight financial conditions remain at present. But the other inflows to the balance of payments, mainly the current account, are showing a faster recovery. The workers' remittances are edging up, which are above $500 million level in July, and we expect the same trend to continue, which will give us over 6 billion workers' remittances this year in total. And the tourist arrivals are also showing a faster normalizations towards 200,000 arrivals a month level. And we have sort of estimated tourism earnings of about 2.3 billion during this year compared to 1.1 billion last year. Exchange rate recorded an appreciation thus far during the year at 12.1% with some volatility, and the official reserves also are remaining at healthy levels, and we are taking measures to repay some of these maturing debt obligations, particularly we have partly settled the swap facility with the Bangladesh Bank, and we continue to repay the maturing debt of multilateral lending agencies going forward as well. On the credit front, we are yet to see a sustained recovery. As you can see here, there has been a contraction on month-on-month basis from June last year till May this year. June showed some sort of expansion, but July we again see a moderation of that expansion. So we are yet to see a sustained recovery of credit to the private sector. That's why we want to incentivize credit to the private sector by lowering the lending rates faster. So the Monetary Board anticipates a faster reduction in overall market lending interest rates in line with the recent monetary easing measures, thereby availing credit for productive sectors of the economy. And the monetary policy measures implemented thus far are expected to help stabilize inflation around the mid-single digit levels over the medium term.